Welcome back to our special show, Fed Watch. We are trying to analyze the Fed's decision and the impact of this rate hike and the promise of 3 more rate hikes next year. We have with us Nick Parsons of National Australia Bank. Nick, thank you very much for joining us. Well, first up, yes, the hike was there, but what were your key takeaways from Yellen's speak?
Well, the overall feeling that was left by both the statement and Miss Yellen's press conference was that the US is going to be prepared to raise rates a little more than had been expected. There were no surprises in the growth numbers, no surprises in the unemployment forecasts, but I'd just point out 2 things. Firstly, the dot point showed 3 rate hikes instead of 2. And secondly, Dr. Yellen gave a very strange answer to one of the questions when she was asked about running the economy hot, which is a phrase that she'd used some months ago, but she claimed never to have said it. And so that certainly gave a slightly more hawkish interpretation on the whole statement and the whole policy actions. And I'm surprised the market hasn't picked up on that a little bit more this morning in European trading.
Mr. Parsons, should we compare this hike to the Alvin Greenspan hike of 2003, which of course was followed by growth in the US and even in emerging markets? So, I mean, is this really a good hike?
Well, it's a very good question that you pose there, but I don't think the 2 periods are similar. Remember that under Alvin Greenspan, we had 17 consecutive meetings at which rates were raised by 25 basis points. Cumulatively, it was 4.25 percentage points of tightening. Now, I don't think that we're going to be looking at that sort of degree of tightening, and it's more likely that the terminal rate for Fed funds is somewhere in the 2.75 to 3% range. So I don't think we're going to go as high, and I don't think we're going to go as quickly. So I think there are great differences between these 2. And what's interesting is if you have a look at what's currently priced in the market, if you look at the euro-dollar futures for December 19, they're currently very, very close to what the Fed believes is the longer-term rate for Fed funds. So there's less discrepancy between the markets and the Fed than there has been at any point over the last 5 years.
All right, let's get to emerging markets. What should emerging market investors take away from this hike and the indications of 3 more next year?
Well, equity markets have thus far been focused on the growth dynamics, both the growth that's already in the US economy and that which is still to come from an expansionary fiscal policy. The worry will come. I can't put a timing on it, and I can't put a level of the equity market, but I can give you the trigger. I think the warning will come when equity markets take fright at the level of bond yields. Now, it hasn't happened at 2%, at 2.25, and yesterday when we went through 2.50 on the 10-year, the equity markets haven't yet taken fright. But if this bond market, if the rise in yields in the bond markets continues, then I think at some point we are going to see a sharp snapback in equities. We're not there yet,
Sure.
But I think that's the thing to look for.
Sure, to 40, 50, 60, those numbers just keep climbing. So where would smart money go now? And what should smart money be wary of?
I think when we ask about smart money, we've got to talk about the smart short-term money and the smart longer-term money. And the smart short-term money is going into the dollar. We've seen that the dollar against the euro, we've seen the dollar against EM, and there was certainly no pushback from Dr. Yellen. She didn't in any way show her concern that's been previously expressed about the impact of the dollar in tightening US financial conditions. So the smart shorter-term money is going into the dollar. But if we see bond yields backing up, and if we get the 30-year up at something like 3.50, we're not there yet, we're around 3.20, but if we start to see long-term bond yields rising above inflation, and not only just above it, but also with a decent real return, then some of that longer-term institutional money that's been chasing into equities will flip back into the bond market, because longer-term investors who've got pension funds to manage would prefer bonds if they're providing a decent real return. So over the longer term, we are going to see money going into bonds, but not yet at these levels. They're not yet at the point where they're really, really attractive.
We'll leave it at that. Nick Parsons, always a pleasure speaking with you. And on that note, let's welcome Alvin Tan, the currency strategist at SocGen. Alvin, thanks much. Well, Martin Wolf, just before we connected with you, and Nick Parsons have been speaking about a strong dollar. What will be the negatives if the dollar continues to go to, what, 105, 108? Are we going to have something like that renminbi depreciation scare that we saw Jan 2016?
Yes, indeed. That would be a tightening impact on the world, certainly, and also on the United States, too. Though for the U.S., given the expected fiscal stimulus that should come on once the Trump administration is in place, that should be less of a concern in the U.S. But certainly in EM, even in China, in fact, in the last few weeks, we have seen deposit rates in China are rising into year-end. It's not unusual for short-term interest rates in China to run up into year-end and towards the Chinese New Year. But certainly this has coincided too with the very strong dollar trend that's been in place for approximately 2 months now. So certainly we do think that it does increase the risk for emerging market assets and currencies in the near term.
How much more do you think dollar can go? Are we going to see a DXY of 108, 110, or any other pairs that you want to speak about?
Well, actually, the thing is, we do think the dollar can do well into early next year. But actually, we think that against the euro, for example, dollar gains will be limited. We do think that euro-dollar would fall to parity. But that's also as much to do with dollar strength as it is to do with European weakness. In particular, European political risk, we think, is likely to rise into the French presidential elections in the spring. But from parity, we think that euro-dollar will start to rise from about the spring, the middle of next year, as the ECB tapers of its asset purchases further.
Do you worry about the rupee?
In terms of the rupee, I mean, it's unlikely that it would be immune to further dollar strength, especially in EM space. So we would expect further pressures on that too. On top of that, of course, India is still running a current account deficit, so that makes it vulnerable if there were to be volatility spikes in global asset classes on account of the tightening liquidity we're seeing across the world.
All right. Alvin Tan, pleasure speaking with you. Thank you very much for joining us. As